Hello, this is Tim Congdon. I'm Chairman of the Institute of International Monetary Research at the University of Buckingham. This is the latest monthly update of the international monetary scene. I'm talking in April 2018. Quite an interesting time. There's been a change of view about the world economic outlook. You may remember last autumn I said there was going to be a slowdown in money growth in both the United States of America and the Eurozone, and I therefore said that there were quite a high likelihood that the growth of demand and output would run at a slower pace in the world economy in 2018 than in 2017. That was not a widely prevailing view at the time. And in fact, the International Monetary Fund at the end of last year gave a rather positive message about the outlook for 2018. Anyhow, the change that has occurred is towards the sort of view I was expressing last autumn. We have seen slower growth of money in both the USA and the Eurozone, and there have been signs not of recession, but of slower growth in both of these major parts of the world economy. Last month, I looked at the situation in the United States of America. This month, I want to look at the Eurozone. Here you can see the chart of the 3-month annualized rate of growth of the quantity of money. It's a very sensitive short-term indicator. In the last 3 months, money has risen by that much. In a year, it'll have risen by that much. Okay, and the figure, in fact, is about 2%. A very low figure. In the kind of work that we do at the Institute of International Monetary Research, we identify these trends because we believe that there are certain strong tendencies that we see all the time, at least in economies of modern type with banking systems and a central bank. In the long run, there's a link between the rate of growth of money and the rate of growth of nominal GDP. And in the short run, there's also a relationship between real money and economic activity, even if it's not very exact. It follows from that large changes in the rate of growth of real money, money adjusted for the effect of inflation, are practically always important to economic activity, employment, and so on. Now, at the moment, as I've just been explaining, in the Eurozone, there is a clear slowdown in money growth, and this is something which one has to express concerns about, particularly because the European Central Bank has said that it's going to be reducing its asset purchases further later on this year, and indeed will stop them altogether in September. So there has to be a worry about, well, let's try and think about this situation going back with some recent history. What I want to do here is to look at money trends in the Eurozone going back to a bit over a decade now. I want to go back to, to 2005. What I've got in this chart is both the annual rate of growth, which is of money, which is shown by the blue line, and the 3-month annualized rate of growth, which is much more ups and downs, which is the red line, and the very last figure was the one I showed you at the start. Now I could say you can split this chart of the Eurozone into 3 periods. There's the boom-bust period, 2005 through to about 2010, when indeed we had a small boom in 2005, 6, 7, early 2007, and then the Great Recession, of course, in 2008 and 2009. Then a kind of period of failure really to make any recover properly, which was from about 2010 through to about 2013, 2014. And the Eurozone, unlike the USA, unlike the UK, unlike Japan, did indeed have another mild recession in that period. Then you can see more recently, roughly speaking from the end of 2014 through to today, the growth of annual rate of growth measured by that blue line, about 5% a year. And this has been a much better period for the Eurozone. There's been cyclical recovery, unemployment's gone down, inflation has returned at a very low rate, fears of deflation have been wrong, and so on. So that this increase in the rate of growth of money from 1 to 3% in the early 2010s, up to 5% in the last 3 or 4 years has been a better period for the Eurozone. Now let's just return to my first chart. You can see we've gone down from about 5%, well, at the very start, about 7% to 2%. Okay? That 2% carried on the next few years, that other chart would look like this. We'd get back to where we were in that very difficult period for the Eurozone between 2010 and 2014, when not only was there another recession in the Eurozone, but you even had worries about, can the Eurozone continue, because Greece, for example, threatened to leave. If Greece leaves, then will Portugal leave. If Portugal leaves, will Spain leave. If Spain leaves, will Italy leave? It was an existential crisis for the Eurozone in that period. All that's died down since the 2015 with QE and so on. Where are we going from here? I showed you that the growth rate of money has slowed down. Part of the reason for that is that last autumn, the European Central Bank reduced the pace of quantitative easing. Let's just explain a little bit more about what quantitative easing is. Quantitative easing, in the way that it's being organized at the moment, involves central bank purchases of assets from non-banks, as well to some extent from banks. When anybody buys something from me, it goes into my bank deposit. So the effect of the central bank purchases of assets from non-banks is to increase the quantity of bank deposits, which is the quantity of money. Okay, that's what we're measuring in these charts I've just been showing you. So the effect of QE, these asset purchases by the European Central Bank, has been to boost the growth rate of the quantity of money. There are some difficulties with these operations, which I'll come to later on. And these difficulties caused the European Central Bank last autumn to reduce the rate of purchases of assets. There had been a period when these asset purchases ran at 80 billion euros a month. They came down to 60 billion euros a month. Last autumn, they decided to reduce to 30 billion euros a month. And that, I suggest, is why we saw that slowdown in money growth. Let's look at this chart now. This shows you APP, monthly net purchases by program. APP is the asset purchase program of the European Central Bank. And then there's different types of assets being bought. The blue area, by the way, is purchases of assets issued by governments or public authorities. They're the dominant part of the asset purchases. What I want you to notice here is that, well, at the very end of those bars, there's a collapse to zero, a cliff in effect. That is in September 2018. The reduction from 60 billion to 30 billion has led to a slowdown in money growth, about 2% annualized. We're going to come in September to a complete cessation of these purchases if the ECB sticks to what it said. What happens to money growth then? Does it fall to nil? If it falls to nil, we get back to the period of trauma in the Eurozone between 2010 and 2014. That's why this subject is so important. In effect, we have in the Eurozone, you might call a monetary cliff coming up in autumn 2018. I use the phrase because we had a fiscal cliff in America at the end of 2012, and in the end that turned out to be a damp squib. I never have any time for fiscal policy. My guess is that the end of QE, the end of these asset purchases in the Eurozone could lead, in fact more than a guess, I'm pretty sure of it, will lead to money stagnation and then all of these further problems. Now, obviously, the question then is raised, well look, surely this is going to happen. Something will change. The way the money stock grows, money is liability of the banks. Deposits issued by banks, obviously we hold them, use them as money. Money grows because the banks can expand the other side of the balance sheet, their assets, and it can do so either by lending to the state sector, the government, local authorities or whatever, or by lending to the private sector. Now, The problem that the Eurozone has had since 2008, 2009 is that the banks have been struggling to increase their assets, their risk assets, their loans to the private sector, because they have been at difficulty meeting capital rules imposed by the G20 nations working through the Bank for International Settlements in Basel. There's an arrangement called the Basel Rules. Basel III we're into at the moment, perhaps possibly Basel IV, trying to make banks have ever more capital relative risk assets, so the banks have been holding back the growth of risk assets, holding back loans to the private sector. The purpose of the asset purchases, quantitative easing, has been for the banks instead to increase their claims on the state, on the central bank, and then that boosts money on the other side of the balance sheet. What's been happening to lending to the private sector in the last few quarters? Could that revive spontaneously, with nothing further happening, to offset the end of the asset purchases, the monetary cliff that's coming up in autumn 2018? Well, I don't think so. And you look at the latest numbers here, you can see why I'm so sceptical. So what is going to happen in autumn 2018? Could there be a return to asset purchases? And logically, since it's been a successful program, logically that's surely what should happen. No. The problem here is that the Eurozone is not a standard monetary arrangement. It's a very special arrangement in which the same currency is shared by several countries. And if the European Central Bank buys the government securities of one government, so Italy's, then if it buys too much of Italy's government debt, then maybe other countries won't like that, because it makes life easy for the Italian government. And the Germans have had a very strong position on this in the last few years. They don't like the asset purchases. They make life easy for nations they regard as rather financially responsible, like Italy. And we have at the moment in particular a big problem in what's called the Target 2 settlement system. This shows you the balances of different countries' banking systems. It's a very technical subject, I'm sorry about that. Nevertheless, you need to understand what's going on to see the kind of crisis the Eurozone is in. The Target 2 settlement system is a clearing system between the banks in the Eurozone and different nations' banking systems out of all of their credits, out of all their debits. Some nations will have a credit position, some nations will have a debit position. You can see at the moment that Germany has got a huge credit position. In fact, it increased quite a bit last month. These figures are monthly. They go back to well before the crisis, when in fact this really wasn't a problem at all. It goes back in fact to 2001, the very start of the single currency. The big debtor nations in this Target 2 system are Italy and Spain. And you can see they're still slipping away, those red lines still slipping away as the months go by. The point here is that the German banks, the German banking system, Germany as a nation, receives no interest on this vast sum of money, about 850 billion euros. It receives no interest, and in a sense, Germany is being taken for a ride. It's complicated, I can't explain it here now. But the asset purchases have the effect of increasing the German credit position and increasing the Italian and Spanish debit position. The Germans don't want this to continue. They're opposing the continuation asset purchase program beyond autumn this year. I don't know what's going to happen. I think it's quite likely, however, that you're going to see pressure from the Europeans for an easing of the restrictions on bank credit that have arisen from the application of the Basel rules since the Great Recession. The European banking system has in fact increased the capital asset ratio dramatically since the crisis. A return to the kind of capital asset ratio seen in the banking system before the Great Recession, when the situation was relatively okay. We had some stable years, prosperous years in the Eurozone in the early 2000s. An easing up of those rules would allow the banks in the Eurozone to start lending again to the private sector, and that then might make things more manageable for autumn this year. Thank you.